Diamond Dave, the founder of the highest paid part-time job in the world options trading program. And what we're really quickly going to talk about is options pricing, right, plus volatility. And what I want to really explain to you is that this is going to be a understanding of how options pricing, right, is affected by volatility, also affected by theta, but kind of vice versa. And this is going to be really, really good information for our traders. I really want to understand how they can not lose money in the options market, even if they make the right actual directional call. So what can happen is that because of volatility and how it affects pricing, you can make the right call from a directional standpoint. You can make the right call from an expiration date standpoint. But because volatility and also because of theta, it can make it to where you may not lose money, but you may not make as much money as you thought that you were going to make on those particular contracts. So if you're trying to figure out how to avoid that, this is going to be a really good video for you. And this has happened to me multiple times. The last time it happened to me, I was doing DoorDash puts. When I bought the contract, I paid a particular premium, even though I got the right direction to move. When I sold the contract, the premium was not as anticipated, and it's because of volatility and how it affects options prices. And I probably will put this video, and not this video, but I probably will make another video and put this in my training course because this is higher level content. But I just wanted to make a video to create some content. But what I probably would do is take this video off. So if you are here and you're able to still observe it, I would tell you to try to apply it as soon as possible, because what I'll probably do is take this content, redo it over with some illustrations, and probably put it into my internal course. So this is what I want you to understand. There's several ways in which this plays out. So the reason why I teach two Greeks, which is going to be implied volatility, or sometimes called sigma, or also theta, which also is known as time expiration or the expiration of the contract, is because to me, those two particular Greeks have the most impact on the price of the actual contract. So they have the most impact on the premium, which determines whether or not those contracts are going to be profitable for you, or they're going to expire worthless or not as profitable as you thought they were going to be. So I really get people to really understand those two particular Greeks. A lot of people like to teach Vega and all that. To me, those are not as important as implied volatility and theta decay. So here's the scenario. Let's say hypothetically you buy a contract for company XYZ. You buy that particular premium for $100. It's a call contract. You anticipate it to be let's say a $10 move. You buy that particular contract, let's say hypothetically in this example, $2 out of the money, right? So let's say the strike price, let's just say to make this easy, company XYZ, the strike price when you buy the contract is at $10. You buy a $12 call, you expect a $10 move, you buy with a 2-week expiration, okay? Things happen the way you want it to happen, okay? So you buy that particular contract, let's say in this scenario, for $100. Things happen the way you want it to happen. You get the expected move within the first week. It moves to that particular $10 mark. So it goes from, I think we said the price point was $10, the strike price was $10. Let's say it goes to $20 within the first week, right? You bought for $100. You got a week left, the expiration on the contract. You got the expected move in the first 5 days of the contract, right? Let's say the volatility on that at the time you bought the contract was 100, which is a little high, but I bought contracts with volatility way higher than that. So we got all these different things that I don't really want you to miss it in the details, because I want you to understand the overarching principle. Implied volatility was 100% when you bought it. You got the expected move. You exited at profit because you got the expected move before expiration date and essentially at the midpoint. Here's the second scenario. Let me try to lay it out and make it a lot simpler. Company XYZ, strike price of $100. The contract premium, strike price of $10. The contract premium, let's say hypothetically in the scenario, is $100. And let's say the volatility is 100, just to keep the numbers really simple. You have an expiration date of, let's say hypothetically, 4 weeks, which is going to be a month. Strike price of $10. You believe the expected move to be hypothetically, let's say $10 more. So you expect it over the course of the month, it will exceed that $10 expected move. You paid a $100 premium. Let's say by the third week, that particular share price, even though you bought it to be, let's say $2 out of the money, has not moved, is neutral. What will happen is because you're not getting the expected move, the market makers will reset the volatility. So over the course of those next 3 to 4 weeks, that 100 volatility may now get reset, right? So now you have to have a higher expected move to increase the premium. So what you got to really understand is that, and I hope I didn't make this like a convoluted explanation. When you're looking at contracts and you see the volatility, if you don't get that expected move, right, within that expiration date, it can impact your contract. But what you got to really understand is that the market makers can go in and change the volatility forecast based on the market conditions. So you can buy the contract at this particular date. The market makers can go in and change the volatility forecast on your contract, and it can lower your premium. So let me give it a really good example so you can understand it. Last year, Tesla was going into earnings, and this was the earnings that they were going to be, I think, 4 quarters profitable, right, from a gap standpoint. And so a lot of people believe that after they came out with that particular confirmation of profitability, that the share price was going to move up. So I had bought an options contract about 2 weeks before that particular earnings date. That earnings date I remember was on a Wednesday. What happened was the market makers a lot of time on the week of earnings will go in and put in an expected move from a volatility standpoint. So they may say after earnings expected move is plus or minus 6%. Plus or minus 14%. So you can take that particular share price, and what you do is for that at the money option, you take the what we call the, I think it's really the at the money price. So whatever that particular share price is when they create that weekly contract, and you can determine based on that what the expected move is, or you can wait for them to give you the expected move. So they normally the day of earnings or the day before earnings, they will come out with what the expected move is. The volatility now is going to be set for that expected move. So you could have bought the contract earlier, but if it expires that particular week, right, they now will go in and reset the volatility forecast. If once that particular earnings takes place, and if it doesn't move based on that volatility forecast, those contracts immediately start to lose premium. So in this scenario with Tesla, once they came out with the fact that, yes, we were gap profitable, and now we have the potential to be brought into the S&P 500. But the market makers had created an expected move of $170. So it was 170 up, 170 down. This is before Tesla had stock split. So it was a very volatile ticker. The problem is that I needed that contract to exceed that $170 move for my premiums to start to pick up. If it doesn't exceed that $170 move, because I had an out of the money contract, I would start to lose premium. So on that Thursday, when the market opened and Tesla didn't run in one direction, essentially traded neutral or horizontal, my contract started to really, really lose premium. My mistake was I held that contract till after earnings. This is why I teach people don't ever hold a contract until after earnings unless you're willing to lose everything on the contract. Because what can happen is in that scenario, that contract was positive on Monday. But I was greedy and thought that, well, you know what? If they get this information and they get this news about the fact that they were profitable, it's going to really move this stock and I'm going to be able to make more money. So I was probably positive on that contract by maybe $300 on that Monday. But at that time, I was making so much money on Tesla contracts, I didn't think that was enough money. Now I'm up $300 on the contract, but I didn't want to take that profit because like I said, I was being greedy. This time I was still really learning how to trade. So I didn't take the money on the Monday. I waited until the Thursday, and then all of a sudden I lost money. And this is because the market makers can manipulate implied volatility anytime they want to. So this is why I tell people, when you're looking at an options chain, you can't determine just by delta how much that contract is going to be worth to you. You can determine at that time because that's a snapshot. But the market makers at any time, because they actually are making the market for those contracts, they can go in and determine the volatility. Now, you can, when you sell your contract, you can set whatever price that you want to set. But the problem is that if the rest of the market is selling at one price and you're above that, why would they buy from you when they can go to the market and get that particular contract at a much lower price with the exact same terms of the contract? So you got to really understand is that when you're looking at contracts, if the volatility is at a certain number, that's the expected move at that particular time. On face value, if that share price does not make that expected move, you're going to lose money. However, market conditions can change, and as a result, the market makers can go in and reset those volatility forecasts, and they can do it in the middle of your contract. So this is why I get people to understand the best thing to do is to buy contracts and the volatility is low. Why? Because if they raise the volatility forecast, right, what it will do was it will increase the premiums, and you'll make money just off that. You understand me? So when I was looking at AMC contracts today, because we know that AMC ran up, their volatility on a lot of their contracts is like 300%. The problem is you're going to have to get a massive move on those contracts for those contracts to be profitable. Excuse me. The market makers can go into the actual options chain and they can raise those particular volatility up to like 400%. Now you bought the contract when it was 300%, now it's 400. You got to get even more of an expected move, right? It's very unlikely they're going to lower those volatility forecasts until this whole scenario where AMC is over. So what the market makers have already done is they've already factored volatility into those particular premiums of those contracts to protect themselves against having to pay out if the contracts really move really rapidly. They don't have to go in and raise volatility. They already have jumped the volatility up. So these are the kind of the final points of trading options that you really got to understand. There's people in the options market that just trade volatility. They don't care about the ticker. They're just looking for volatile scenarios where they can trade volatility because they understand that this particular scenario has a potential to be very volatile. But these are some of the final points of the options market that the average person is not really exposed to. And even if you're selling options, you have to understand that it's more profitable to sell options when the situation is very volatile, like right now with AMC, because you can get more premium as opposed to selling options in a scenario where it's not as volatile, where you can get less premium on face value, right? Now, at the same time, so you got to kind of understand that. So when you're looking at your options chain, make sure that you factor in the volatility forecast. If it's too high, right? And when I say too high, I mean like over 100%, understand that you're going to have to get a really, really strong move in that particular direction to make those contracts profitable. So if you're looking at a particular ticker and the volatility is already, I mean, when GameStop was making its first really big, strong run, I saw volatility on some of those contracts at literally like 1,000%, 2,000%. There was no way in the world I was going to buy that because it was just so high. I'm just giving the market my money. Even if I get an expected move, the move has to be so bullish or so bearish with so much velocity or so much volatility. That's the only way I can make my money back out of those particular deals. And if it moves very gradually, or if there's going to be a long extended move over time, it's going to put me in a position where it's going to be hard for me to get my premium back out of the market. So this is why I really encourage people to, in your spare time when you don't have anything going on, look at options chains and just look at, based on the particular scenario with this company, how have the market makers price volatility? Based on going out with expiration dates, how is volatility priced? Because of what a lot of times is that there's really, really good contracts on options chain that the average person may not be aware of because they haven't really looked at the whole chain. I will look at an options chain going out 2 years because I want to see every contract that there's availability sold. What's the volatility? What are the strikes? What is the spread between the bid and the ask? What was the last price? And I will literally spend hours just looking at options chains because I'm trying to understand from a comprehensive standpoint, what's the total scope of the options chains for this particular company? Because I want to understand what do the market makers believe are going to be the expected move for this particular company. And then what are people currently paying for contracts right now, right? And then once I absorb all that information, then I turn around and I start trying to figure out what contract I want to buy. So I will spend a long time just looking at options chains because essentially that's the market for contract for that particular company. So I hope that the explanations weren't too convoluted. I hope they weren't like, very, very technical. Like I said before, is what I'll probably do is do a video for my course where I kind of will show you with examples what I'm talking about. But right now, what we have going on in the market, especially with AMC and GME, these are really good examples of options pricing and volatility and how you can buy the contracts at a particular price. And if you don't get the expected move based on the volatility, it's going to be hard to get your premium. But what may happen is that the market makers could go in and raise the volatility, right? And it's going to be difficult for you to get your money. Let me give you another example before I get out of here. The VIX a lot of times can make the options market, right, become more volatile. So what can happen is this can work in your favor or against you. You can buy a contract on day one. The VIX at that time can be very low. Like right now, the VIX is really not that high. I think the VIX sold off today. So you buy the contracts, the volatility is not that high. What can happen is the VIX can move up, and maybe based on the company that you're in, based on the scenario, as a result, the premiums on your particular contract, because of volatility now starts to raise, will go up. So just on that, you can sell those contracts for more money because the VIX affected the volatility of the market, which raised the premiums on your contract. But on the other hand, if the VIX is really, really high and you buy contracts when the VIX is really high, so the volatility on that particular company that you're looking at has spiked the contracts. If the VIX starts to go down, which therefore affects the volatility of the market, which means that now your particular scenario is not seen as volatile, right? What they can do now is decrease the volatility. So what does that do? Just on the face, it will decrease the premium on your contracts. So this is why you got to take these things into account when you're looking at the actual market. This is why it's very important that you understand how the market works. One piece of information is not sufficient enough to make a determination. This is a discretionary space where you got to be able to take in information and have discernment about what's going on. So you got to be able to understand what are the actual pieces that make this market move around. And then how can I take in that information based on those particular pieces and try to figure out, based on my discretion or my discernment, what particular type of action that I decide to take, if I decide to take any action. Because sometimes in this market, the best thing for you to do is not to do anything and wait for a great scenario that you feel like you can capitalize on. So hope that this was going to be, this was valuable to you on some level. Hope it wasn't too technical. Hope I gave you really, really clear examples. I tried to, but I think it may be better if I can actually show people on the screen what I'm talking about. If you got any questions, hit me up in the comments. If you want to learn more about the highest paid part-time job in the world, reach out to me. Options, the VIP course is rolling out on the 1st. I got all the content up. So that's not going to be an issue. So right now, what I'm just working on is like the front end aesthetics of the actual landing page and the thank you page and that nature. But all the content's there. So I spent a lot of time just getting that content together. So if you got any questions, reach out to me. This is David W. Williams, also known as Diamond Dave, and I'll talk to you later.